let's take a look at some other useful things that we can do with cost, volume, profit analysis. In the last section, we took a look at how to use cost, volume, profit analysis to find how hard we have to work to achieve a certain target pre-tax operating profit. But sometimes that's not what a firm wants to know. They want to know how hard they have to work to achieve some desired after-tax profit. In that case, the easiest way to solve that problem is to determine how much pre-tax profit we need to generate in order to get the after-tax profit that we seek. To figure this out, let's take a look at some income tax formulas. We agree that if we take our pre-tax profit and we multiply it by the tax rate, that will tell us how much income tax we have to pay. Well, in that case, it's fair to say that our pre-tax profit minus the income tax that we have to pay gives us our after-tax profit. We can substitute for the income tax that we have to pay like this. The income tax that we have to pay is equal to pre-tax profit times the tax rate. So we haven't changed the value of the equation. We've just re-expressed it. Now, from this equation, we can extract out pre-tax profit and distribute it like this. Pre-tax profit times 1 minus the tax rate gives us our after-tax profit. Why does that work? Well, let's say the tax rate is 30%. If we give 30 cents out of each dollar to the IRS, doesn't that mean that we're keeping 70 cents out of each dollar? So 1 minus the tax rate represents the amount out of each dollar of profit that we get to keep. Now all we have to do is rearrange the equation like this. Take our after-tax profit, divide by 1 minus the tax rate, and that will give us our pre-tax profit. So let's see what we can do with this equation. For example, in the previous section, Dave had wanted to generate $1,800 of pre-tax operating profit. Now he wants to know how hard he has to work to generate $1,800 of after-tax profit, and in his world, the tax rate is 40%. So we take our formula for changing after-tax profit back into pre-tax profit, like this. And we substitute what we know. Our after-tax profit that Dave wants is $1,800. The tax rate is 40%. If we divide our after-tax profit by the portion that we get to keep, 60 cents out of each dollar of pre-tax profit, that tells us that we need to generate $3,000 of pre-tax profit in order to end up with $1,800 of after-tax profit. Now all we have to do is substitute that number into our equation, and we end up with $3,000 of pre-tax profit plus $1,500 of fixed cost must be covered by our contribution margins. If you remember, Dave sells his donuts for 60 cents each. His variable cost per donut is 36 cents each, so he has a contribution margin of 24 cents per donut. He needs to sell 18,750 donuts in order to achieve his goal. The effect of that will be that each donut will cover its own 36 cents of variable cost, leaving him with 24 cents of contribution margin. 24 cents per unit times 18,750 units will give him just enough to cover his $1,500 of fixed cost and give him $3,000 of pre-tax profit. Does this work? Let's take a look. If Dave sells 18,750 donuts at 60 cents each, and each donut has a variable cost of 36 cents, that will give him a total of $4,500 of contribution margin. Subtract out his $1,500 of fixed cost, and that gives him $3,000 of income before income taxes. Subtract out the 40% tax that he has to pay, and that leaves him with exactly his desired target after-tax income, $1,800. So let's try a practice problem. A firm produces keychains, and we're given some information about those keychains. We know the selling price, we know the variable cost, we know the tax rate, and we know the fixed cost. My question to you is, if the firm wants to earn a total of $10,500 of after-tax profit each month, how many keychains does it have to sell during the month? Well, let's take a look. First thing we have to do is turn after-tax profit back into pre-tax profit, and we do that by dividing by 1 minus the tax rate. In this case, the firm wants $10,500 of after-tax profit. They have to give up 30 cents of each dollar to the IRS. That means they get to keep 70 cents out of each dollar. Therefore, they have to generate $15,000 of pre-tax profit in order to end up with $10,500 of after-tax profit. Now, all we have to do is work that into our cost volume profit analysis. We know that contribution margin is the difference between the selling price and the variable cost. In this case, they sell their keychains for $1. The variable cost is 40 cents, so the contribution margin is 60 cents per unit. Then we can plug this into our basic formula. The number of units will equal the profit that we want plus the fixed cost that we need to cover divided by the contribution margin per unit. So let's fill in the equation. Our desired pre-tax profit is $15,000. Our fixed costs are $3,000 per month. Altogether, that's $18,000. at 60 cents contribution margin per keychain, that means we need to sell 30,000 keychains. That will give us just enough to cover our fixed cost and give us $15,000 of operating profit. Then we'll pay our taxes and we will be left with our desired after-tax income. Another interesting thing that we can do with cost, volume, profit analysis is to do what's called sensitivity analysis, or what if analysis. For example, let's say that Dave's current fixed cost of $1,500 a month can only handle making 5,000 donuts. That's a problem because Dave's break even is 6,250 donuts each month. He doesn't have enough capacity to break even, but he can rent another oven for $480 a month. What is that going to do to his break-even point? Let's take a look. The formula for break-even is the fixed cost divided by the contribution margin. His fixed cost is currently $1,500, but if he has to rent another oven, that brings his fixed cost up by another $480. His contribution margin per donut is still 24 cents. That means he needs to sell 8,250 donuts just to break even. That's significantly more than before. Specifically, he needs to sell an additional 2,000 donuts just to break even. And that additional 2,000 donuts at 24 cents each will give him the additional contribution margins to cover his fixed cost. So then the question is this good news or bad news? Yes, his break-even increased, but given that his current fixed costs wouldn't even allow Dave to break even because he could only make 5,000 donuts a month, renting the extra oven might be a good idea, because once he has passed the break-even point, every additional donut gives him 24 cents of contribution margin. If Dave doesn't think that he can sell 8,250 donuts each month, then he really needs to rethink his entire business model and find a way either to increase his selling price, decrease his variable cost per unit, decrease his fixed costs, or some combination. If he can't do that, it would be very difficult for him to stay in business for long. So let's take a look at a practice problem for sensitivity analysis. A firm sells a product for $2 each. They have $12,000 of fixed costs and 80 cents per unit of variable cost. They have the opportunity to get a new machine that would decrease their variable cost per unit to 68 cents, but it would increase their fixed cost to a little over $15,000. Should the firm get the new machine? Well, let's think about it. The old contribution margin was the difference between the selling price and the variable cost. $2 minus 80 cents equals $1.20 per unit. And the old break even was the fixed cost, $12,000, divided by the contribution margin, $1.20. That means that previously the firm had to sell 10,000 units just to break even. Now, if the firm gets the new machine, the price doesn't change, but the variable cost does. Now the variable cost is only 68 cents. That means that the contribution margin per unit goes up to $1.32. However, it also increases the fixed cost for the firm. The new break-even point is going to be the new fixed cost, $15,180, divided by the new contribution margin, $1.32. Now, our break-even is 11,500 units. Obviously, the break-even has increased. So, my question to you is this good news or is it bad news? The answer to this question is not so simple. It depends. If the firm thinks that it can sell significantly more than 11,500 units, it might want to consider getting the machine, because for every unit above break even, the firm will get to keep more contribution margin. However, if the firm is not sure whether it has enough customers to cover the increased break-even point, then it might want to consider some other strategy. The basic rule here is that numbers advise us, but they don't rule us. That's good news for you. You need to be a smart manager who has a good understanding of your firm, your industry, your customers, so that you're able to make the smart strategic decision that will enhance your firm's value. Now let's take a look at a different situation. Up until this point, we've been assuming that our firm only sold one product. That's very unlikely in the real world. So let's take a look at how to do cost, volume, profit analysis for a firm that makes more than one product. In order to do this, we need to be able to make a simplifying assumption. That is, that we know the proportion of each kind of product that the firm expects to sell. So for example, let's take a look at Dave's Donuts. Now the firm makes bagels too, and they believe that they sell about 9 donuts for each bagel. Doesn't that mean that 9/10 of all of the units that they sell are donuts and 1/10 of all of the units that they sell are bagels? So let's see if we can use that information to do cost, volume, profit analysis. We have information about the donuts. That hasn't changed. We still sell them for 60 cents each. They have 36 cents of variable cost, giving us a 24-cent contribution margin. The bagels sell for $1 each, have 56 cents of variable costs, giving us 44 cents of contribution margin. And our total fixed costs have increased because we need different equipment to make bagels as opposed to donuts. Let's determine the new break even. If you notice, the contribution of our two products is not the same. That's where knowing the ratio of how many donuts to how many bagels becomes important. Because if we know that, we can make what's called a weighted average contribution margin for the two products. Let's take a look. We know that 9/10 of all the units that Dave sells are donuts, and 1/10 of all of the units that Dave sells are bagels. So we can take 9/10 of the contribution margin for donuts plus 1/10 of the contribution margin for bagels, and that gives us a number, 26 cents. That means that on average, for every 10 units that are sold, if 9/10 are donuts and 1/10 are bagels, the average contribution margin will be 26 cents. And we should always test this number for reasonableness. That is, it should be higher than the lowest number, lower than the highest number, and closer to whichever one represents more of the mix. Once we've computed this weighted average contribution margin, we can use it in our break-even analysis as if it represented one product. So now we're going to take our fixed cost and divide by our weighted average contribution margin. Here our fixed cost was $18.20. We have a 26-cent weighted average contribution margin, and that tells us that we need to sell a total of 7,000 units. But we're not quite done, because we need to know how many donuts and how many bagels that number represents. So we know that donuts are expected to be 9/10 or 90% of all the units that we sell. That means that we expect to sell 6,300 units at break even. Bagels represent 10% of all the units that we sell. That would be 700 units at break even. So altogether, if we sell 7,000 units, and if 6,300 of them are donuts and 700 of them are bagels, our average contribution margin across all of the units that we sell will be 26 cents, and that will give us just enough contribution margins to cover all of our fixed cost, and we will just break even. This same technique can be used for 3 products or 5 products, as many products as the firm happens to make, as long as we can make a reasonable prediction about the proportion of each product within the mix. It can also be used to compute target income in units or in sales dollars. Let's take a look at a practice problem. A firm makes 2 products. We know the selling price and the variable cost for each product. We know the total fixed cost, and we expect that the firm will sell 3 units of product X for each unit of product Y. So the question is, how many units of each product must be sold for the firm to break even? Let's take a look at the solution. We need to find the weighted average contribution margin for each unit. The contribution margin for product X is the difference between its $5 selling price and its $3 variable cost. That's $2 per unit. The contribution margin for product Y is the difference between its $8 selling price and its $4 variable cost. That would be $4 per unit. We know that the firm expects to sell 3 units of X for each unit of Y, so that means that 3/4 or 75% of all units sold will be product X, and 1/4 or 25% of all units sold will be product Y. Now let's put that together to find our weighted average contribution margin. The contribution margin for product X is $2, and 75% of our units are going to be product X. The contribution margin for product Y is $4 per unit, and 25% of the units sold are expected to be product Y. If we crank that out, it turns out that our weighted average contribution margin is $2.50. Remember, this is not a simple average. It's a weighted average. That means it will be larger than the smallest number, smaller than the largest number, but much closer to whichever product represents the larger proportion of all units sold. Now that we have that information, we can plug it into our break-even formula. Our fixed cost is $10,000. If our contribution margin on average per unit is $2.50, that means we need to sell 4,000 units altogether. Now we have to disaggregate that amount into the portion that will be units of X and the portion that is expected to be units of Y. 3/4 of 4,000 units is 3,000 units of X. 1/4 of 4,000 units is 1,000 units of Y. Add them up, they equal our 4,000 units. That's our prediction. Assuming that we actually sell 3 units of X for each unit of Y. If we sell 3,000 X and we sell 1,000 Y, we should just break even.